In today's video, we're taking a look at backtesting trading strategies and why it is so important. It's something that's sad to say, but what many traders leave out completely. So, if you don't want to end up like them, then watch this video.
So Ethan, some people might be wondering what exactly backtesting is all about. Care to explain?
Sure thing, Mike. Backtesting is the process of testing a trading strategy using historical data to see how it would have performed in the past. This gives you an idea of the strategy's profitability and risk before you actually invest real money.
All right, got it. So, where does one start?
Step 1 is to define your strategy. This means laying out the exact rules for entering and exiting trades. Let's take a simple moving average crossover as an example. Here, you'd buy when a shorter-term moving average crosses above a longer-term one and sell when it crosses back below. Be specific with every rule in your strategy because backtesting requires a clear, repeatable setup. In this example, the rules might look like this. You buy when the 50-day moving average crosses above the 200-day moving average, and sell when the 50-day moving average crosses below the 200-day moving average. Clearly defining your rules will help ensure accurate backtesting results.
Okay, what's step 2?
Step 2 is choosing your data and tools. You need historical price data that matches the time frame of your strategy. For example, if you're backtesting a daily trading strategy, you'll need historical daily prices. Many platforms provide free historical data, like Yahoo Finance. If you're using a platform like TradingView, you can set up your backtest directly on the website. Or, if you're comfortable coding, you can use Python libraries like Pandas and Backtrader to analyze data and test strategies. Both options can work well.
Makes sense. So, if I am trading on the 1-hour chart, I am not going to be looking at the weekly chart, even though charts are fractal.
Yeah, that's correct. You want to simulate actual trading conditions as closely as possible.
Okay, what's next?
Step 3 is running the backtest. This is where you put your strategy and data together to simulate trades over time. When you hit run, the backtesting software will simulate trades based on your defined rules, calculate profits and losses, and display the results. Also, keep an eye on key metrics like total return, maximum drawdown, and win rate. These numbers will help you evaluate if your strategy is effective or needs adjustments.
Okay, we are getting there. It doesn't seem so daunting as it did in the start.
Yeah, it's just to get started. This will become like second nature to you.
Okay, let's move on to step 4.
Step 4 is about analyzing the results. The numbers are helpful, but interpretation is key, and it's all going to depend on what you want from your strategy. Here are some main things you can analyze if you don't know what to look for. You can look at the profit and loss of the strategy. Did the strategy make or lose money overall? Also, keep an eye on drawdown. What was the largest drop in value during the test? High drawdowns could mean more risk. What was the strategy's win rate? How often did trades end in profit versus loss? A high win rate isn't always necessary, but it's good to know. And finally, what did your risk-reward ratio look like? Look at your average win versus your average loss. A high risk-reward ratio can make up for a lower win rate.
Wow, that's a great place to start. Remember that these metrics together give you a sense of whether your strategy might work in live trading or if it needs refining. On to step 5.
Step 5 is adjusting and retesting. After analyzing the results, you might notice areas for improvement. Maybe adjusting the moving averages makes the strategy more profitable, or adding an indicator like the Relative Strength Index, or RSI, helps filter out bad trades. Make those adjustments and run the backtest again. It's often a cycle of tweaking and testing until you're satisfied with the results. Mike, do you mind giving the audience a few tips to keep in mind for more accurate backtests?
Not at all. Use realistic assumptions. Factor in fees and slippage, since they'll impact your actual performance. And avoid overfitting. If your strategy is too tailored to historical data, it might not work in live markets. Also, diversify. Try testing on multiple assets and timeframes to see if the strategy holds up across different conditions.
Alright, now we will be doing a demonstration on how to actually perform a backtest.
We'll focus on a popular trading strategy called the moving average crossover. This strategy uses two moving averages, a short-term one and a long-term one, to decide when to buy or sell a stock.
We are going to be using historical data for Apple from January 2022 to January 2023. We'll calculate the 50-day and 200-day moving averages and use them to generate buy and sell signals based on crossovers.
We'll be using PyCharm to code our Python backtest. First, we need to set up our environment. Open PyCharm and create a new Python project. Make sure you have the necessary libraries installed. The ones we'll use are Pandas and Y-Finance.
To install the libraries, head over to the bottom left of your screen. Find the terminal button and click on it. Once opened, type in pip install pandas Y-Finance and press enter. Wait for the download to complete, and the libraries should be installed.
Let's look at the code for this strategy. First, we fetch the historical data using the Y-Finance library, pulling Apple's closing prices for the specified date range.
To do this, type import pandas as PD. Press enter. Then, type import Y-Finance as YF, and skip 2 lines. Next, we'll get the stock data for Apple. We'll pull 1 year of historical data and make a copy to avoid some common warnings. On the next line, type data equals YF for Y-Finance, full stop, download, bracket, and in quotes type AAPL, which is Apple's ticker symbol, followed by a comma, start, equals, in brackets and quotes type, January 1st, 2022, comma, end equals, and again in quotes, January 1st, 2023, close bracket, double bracket, in quotes, close, full stop, copy, brackets, and press enter.
Next, we calculate the 2 moving averages, the 50-day and 200-day moving averages, which smooth out the price data over these time periods. The strategy signal is generated by comparing these 2 averages. If the 50-day is above the 200-day, we're in a buying mode. Otherwise, we're in a selling mode.
Next, we'll check if the data is available. On the next line, type if not data.fullstop empty, colon, and press enter. Next, we'll calculate the moving averages for our strategy. On the next line, type data, open square bracket, in quotes, 50_MA, close square bracket, equals, data, close, full stop, rolling, open bracket, 50, close bracket, full stop, mean, open and close brackets, and press enter. Then, for the 200-day moving average, type data, open square bracket, in quotes, 200_MA, close square bracket, equals, data, close, full stop, rolling, open bracket, 200, close bracket, full stop, mean, open and close brackets, and press enter. Finally, let's generate the trading signals. On the next line, type data, open square bracket, in quotes, signal, close square bracket, equals, open bracket, data, open square bracket, in quotes, 50_MA, close square bracket, greater than, data, open square bracket, in quotes, 200_MA, close square bracket, close bracket, full stop, a stipe, open bracket, int, close bracket, full stop, replace, open bracket, 0, comma, -1, close bracket, and press enter. What this does is create buy signals when the 50-day moving average crosses above the 200-day moving average and sell signals when it crosses below.
Once we have our signals, we calculate the strategy's performance. We do this by shifting the signals and applying the daily percentage change in the stock's price. This gives us the strategy return.
Next, we are going to calculate the performance of our strategy. On the next line, type data followed by an open square bracket, then in quotes, type strategy return, and close the square bracket. After that, type an equals sign. Next, type data followed by an open square bracket, then in quotes, type signal, and close the square bracket. Add a full stop and type shift with an open bracket, the number 1, and a close bracket. Then, type an asterisk. Finally, type data followed by an open square bracket, then in quotes, type close, and close the square bracket. Add a full stop, and type PCT_change with open and close brackets. This line will calculate how much the strategy made or lost each day based on whether we were buying or selling the day before and the percentage change in the stock's price. Once you've typed that out, press enter.
Let's now calculate the 4 key metrics to evaluate our strategy. First, we calculate the total return by summing up all the strategy's returns and multiplying it by 100 to express it as a percentage. Next, we calculate the max drawdown, which is the largest loss from a peak to a trough during the year. This shows the worst-case scenario for how much value the strategy lost at any point. Then, we calculate the win rate, which is the percentage of trades that ended with a profit. We simply count how many of the strategy's returns were positive and divide that by the total number of trades. Finally, we calculate the risk-reward ratio. This compares the average gain of profitable trades to the average loss of losing trades, giving us a sense of whether the strategy's gains are worth the risks it takes.
And to see the results, we just add the code on screen to print the results.
If you run the code, your results will look like this, with total return being 27.42%. max drawdown at 30.75%. You have a win rate of 52.8% and risk to reward ratio of 1.01. So Ethan, is this good or bad? What's going on?
Well, let's break it down. Total return is at 27%. It shows a positive performance. This means if you had followed this strategy over the analyzed period, your investment would have grown by about 27%. A positive total return is encouraging, but it's also crucial to consider other metrics for a well-rounded view. Max drawdown is 30.75%. This is the largest percentage drop from a peak value to a trough in the same period. Here, we're looking at a max drawdown of 30.75%. While the total return is attractive, a drawdown like this means the strategy had some deep dips. Such volatility could be a concern for risk-averse investors who might not want to hold through these big declines. Your win rate is 52.8%. With a win rate of 52.8%, this strategy has slightly more winning trades than losing trades. It's worth noting that a high win rate doesn't necessarily guarantee high returns if the winning trades are small. But this win rate is promising. It means more than half the trades ended in a gain. And finally, the risk-to-reward ratio is 1.01. Lastly, the risk-reward ratio of 1.01 is essentially neutral, meaning that on average, gains and losses were nearly the same size. Ideally, we'd look for a higher risk-reward ratio for a stronger indication that the strategy's returns justify the risks. This balance suggests there may be potential, but it might benefit from some fine-tuning. So in summary, we see promising returns and a positive win rate, but the drawdown and risk-reward ratio suggest that this strategy might be better suited for those who can handle some ups and downs. Like we mentioned, it's essential to refine, backtest, and monitor strategies like these before using them for real trading.
That's a great breakdown. Just a quick heads up, the strategy and code we're showing here are purely for educational purposes and not financial advice. Remember, past performance doesn't guarantee future results, and the stock market always comes with risks. Make sure to do your own research, backtest thoroughly, and if you're unsure, chat with a financial advisor before making any investment moves. At the end of the day, your trading decisions are yours to make.
That's right. We've walked through how to build a simple moving average crossover strategy, calculate key performance metrics like total return, max drawdown, and risk-reward ratio, and evaluate the strategy's effectiveness. Now, you can take what you've learned and start implementing your own backtest with different strategies, stock data, and timeframes to refine your approach. Backtesting is a powerful tool that helps you assess a strategy's potential on historical data before committing any real capital. If you're looking to dive deeper, there are endless ways to expand on this. Experiment with different strategies, refine your models, and always remember to consult a financial advisor or do thorough research before making any live trading decisions.
If you found this video helpful, be sure to like, subscribe, and leave any questions or thoughts in the comments. I'd love to hear your ideas for future topics. Thanks for tuning in, and we'll see you in the next one.